the classified balance sheet assets section. So the first part, as normal, we have on the top of the statement, we have the name of the company. This is Franklin Corporation. This is in your book. This is a balance sheet, and the date is October 31st, 2022. Just like before, the first section is the asset section. Okay, the assets always come first. Now we're going to be breaking things down according to current assets, long-term investments, property, plant, and equipment, or the PPE, and the intangible assets. So current assets always come first. And we're going to talk in a minute about what these specifically are, but we're looking here now at what accounts go where. So the asset section needs to be in order of liquidity, just like when you did the other balance sheet, in order of liquidity. So that means whatever is the most, the closest to cash is the most liquid, right? So under current assets, the first thing you would list would be cash, okay? The second thing you would list would be debt investments, or if your problem has short-term investments. You're not going to have a problem that has both debt investments and short-term investments, so you would have either one or the other. So that would come next. The next account that you would have would be accounts receivable. That would be listed next. The next account would be notes receivable. The next account would be inventory. The next account would be supplies. And then the next account would be prepaid insurance. And that would be the order that you would list those in. And in our book, I will tell you the model that you want to follow. This is the model you want to follow. It's on page 2.4. So on page 2.4 is the model that you want to follow for this. Okay, then you would do your total assets. So total current assets, and so it's 22,100. And then you would go into your long-term investments. So you would have the title long-term investments. And first you would list stock investments, or it might be called long-term stock investments or long-term investments. The next you would list would be investments in real estate. And then you would add those two up, and you would see they push the total over there to the right, and they don't subtotal that. They have a subtotal, but they don't title a subtotal. Okay, so they just added the 5,200 and the 2,000, and they pushed it over to 7,200. The next section is going to be the PPE, or the property, plant, and equipment. So we're going to list land first. Land's going to be listed first. Then you're going to list equipment. And with equipment, there is always a connected account with equipment in the classified balance sheet. And this is called less accumulated depreciation equipment. So those two are always going to go together. So if your problem has accumulated depreciation equipment and has equipment, the less accumulated depreciation follows the equipment number. And then the way it works is that you take the equipment number of 24,000 and you subtract, because this is less, the accumulated depreciation of 5,000, and that's going to give us what they call a book value of 19,000. And we're not going to get too much into what accumulated depreciation is. We have a whole chapter on depreciation. It's a pretty heavy-duty chapter. But depreciation is, this has to do with accounting to where you don't just buy a truck and put the full expense of the truck of 24,000 in the month you buy it. What you do is you spread the cost of that truck, $24,000, over the life of the truck based on its revenue producing ability. So let's say that this truck was $24,000 and it was good for 10 years. Then we would take 24,000 divided by 10, and that means we would depreciate $2,400 a year every year for 10 years. So if we looked at this right here, what this is kind of telling us is that while we paid $24,000 for the truck, in accumulated depreciation, that means we have $19,000 worth of revenue producing ability left in that truck. It doesn't mean the truck is worth $19,000. It means that is our estimation of the revenue producing ability based on the calculations that were done when we purchased the truck and set up the depreciation schedule. And again, we're going to have a whole chapter on that, so don't get too caught up in that. Okay, Now we're going to add the 10,000 and the 19,000, and we're going to push that total over, that subtotal over. Again, this subtotal does not have a title to it. It lines up on the same line there. Then we're going to have the next section, which is intangible assets. And again, we're going to go over what all these are. And under intangible assets, there could be several different things, but we have patents, $3,100. And now we're going to add all the items here in the far right-hand column. Okay, so we've got 22,100, 7,200, 29,000, and 3,100. So we've got total assets of $61,400. Okay, so that is the asset section. So the 19,000 comes from the equipment cost 24,000. 24,000 less $5,000 is 19,000. So it's the equipment less the accumulated depreciation gives us the current book value of 19,000. So that's the asset section. Now we're going to look at the liability section. So on the liability section, we've got, again, this would be on one page, but actually in a real company, these reports are so big that first part, the asset section, could be 10 pages. We're doing very reduced sizes of these statements. So the liability section comes next. And so it says liabilities and stockholders' equity, the title in the center, just like we did before. And now we're going to be breaking it down into current liabilities, long-term liabilities, and stockholders' equity. So under current liabilities, now in the liabilities section, the order does not matter, except you have to have current liabilities first, long-term liabilities second, and stockholders' equity third. Within the categories, you can have them in different order, but again, try and follow the book, because if you put them in a different order, you get your homework wrong. It makes it a lot more difficult for you to go back and be able to check your work. Okay, current liabilities. You're going to have notes payable, 11,000, accounts payable, 2,100, unearned sales revenue, 900, salaries and wages payable, 1,600, interest payable, 450. And then you're going to add all those up. That's going to be total current liabilities, and you're going to push that all the way to the right, 16,050. Then we're going to go to long-term liabilities, and we're going to have mortgage payable, 10,000. And then you're going to see notes payable again. Well, we had notes payable above, right? There's two notes payable. This is going to be determined by the date of the note. So we're going to look at what is the difference between a current liability notes payable and a long-term liability notes payable. Okay, so you list the long-term notes payable. You'd add those two together and push that total over for total long-term liabilities. Then you're going to add those two numbers together, the current liabilities and the long-term, and that's going to give you total liabilities for 27,350. Then you're going to have your stockholders' equity section, and the stockholders' equity section looks just like it did before. You're going to have the title stockholders' equity. You're going to have common stock first, then retained earnings, and that's all we have right now for that section. Again, that section will become more developed as we move on through the course. So we add up the 14,000 and the 20,050. That gives us total stockholders' equity of 34,050. And now what you're going to do is you're going to add the 27,350 total and the 34,050 together. And that's going to give us the 61,400, which is the total liabilities and stockholders' equity. And if we remember from chapter 1, the assets need to equal the liabilities plus stockholders' equity, right? So if we go back to the prior slide and we look at the assets, we're going to see that the total assets were 61,400, right? And now if we go back to the liabilities, the stockholders' equity, you see it's 61,400. So that's exactly what we want. We want the assets plus liabilities, or assets to equal liabilities plus stockholder equity.